Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF. 2017 and 2018 Fund Data Fund Grade A Plus Award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, it's great to be back, Jim.
Ted, how big a deal is Encana packing up its bags, so to speak, and heading to the U.S., closing its head office in Calgary, where it's existed over 100 years?
Well, it's certainly got a lot of headlines, and I believe the company has said it's going to, not touch any Canadian jobs. Well, we'll see about that. That this is essentially kind of a head office administrative move. But the fact of the matter is, they are pulling up their sign from Canadian Oil Patch. They're changing their company name once I believe shareholders have to approve to a name that I can't remember. So good luck with that. And they're going to be setting up legally as an American entity, I believe. Now, what's interesting about this is that I got to believe once you start seeing headlines like this, you combining that with what we've heard about sort of Alberta's separatism and politicians making a lot of noise about the election results and how bad things are in the oil patch. Well, Jim, any investor who's been paying attention to the oil patch knows things have been pretty bad for a long time. And the question for investors is not what politicians are doing or what self-serving heads of corporations may be doing, but whether valuations have baked in all the bad news that could possibly be baked in. And what we're seeing is that when it comes to opportunities in the North American oil patch, so much bad news has been baked into Canadian oil patch stocks that they're trading at absolutely multi-year lows in terms of valuations, where such is not the case in the United States. And in fact, when we're looking at what insiders are doing on both sides of the border, we see a huge divergence. And what I mean by that is we see insiders behaving much differently in the U.S. In the oil patch than we're seeing in Canada. So that leads us to believe that there is probably more opportunity for those looking to invest in the oil patch in Canada than in the United States, because there's more of the bad news has been factored in to the Canadian oil patch stocks than the U.S. stocks. And to look at what we've been doing on that with our subscribers, we've been looking at basically insider buying and selling on both sides of the border. Okay. And in the U.S., we've got two stocks with key insider selling for every one stock with buying. And in Canada, it's just the opposite. Okay. It's more than two stocks with buying for everyone with selling. And this divergence has just really taken place in the last few weeks, where we've seen a lot of selling pickup in the U.S. And the last time, in fact, that we've seen it this low in the U.S. was in October of last year, right before the U.S. energy sector put in a double top, and then it slid into the Christmas Eve washout last year. Now, not suggesting that's going to happen necessarily again, but the divergence between the two is really notable, and I think that for investors, that's the type of thing you want to be looking at, whether what's going on in terms of opportunities between the two. So let's take it for what it is, that insiders are on both sides of the border, when they talk about what they're doing with their cash, are favoring the Canadian oil patch at this point, likely because a lot of the gloom has been factored in. And just to put this in a little bit more of a context in terms of what's going on in the United States, I came across the most recent EIA short-term energy outlook. Okay, and every month the U.S. Puts out a report in terms of what the outlook is for the oil patch, and I'm just going to read a section of it because I don't want to mischaracterize. And in terms of their outlook, basically, here's what they say. Okay, it's the EIA, the Energy Information Agency, forecasts growth to level off in 2020 because of falling crude oil prices in the first half of the year. And here comes the big part, Jim. And continuing declines in well level productivity. Okay, so what does that mean? Well, it means that the government's picking up that these wells are starting to have a harder time with their depletion levels, and then they're starting to deplete faster than in the past, which is a problem for the shale revolution in the United States. And that's really what's been driving things, and I'm not sure that the market has fully priced in that aspect of what might be going on in the United States in terms of depletions of their assets. And it won't be long until, though, the financiers in the oil patch do start to catch on. So we could be in for an interesting period in the U.S. oil patch, and even if crude oil behaves itself and doesn't fall, or even maybe rises a little bit, that perhaps U.S. energy stocks may at least tread water here and not go along for the ride, even if we do get a pickup in crude oil prices or natural gas prices.
Now, the U.S. for the first time has exported more oil than they imported, a slight margin. Is that going to change almost immediately back to importing more?
Well, I wouldn't go as far as that because a lot depends on the demand side. I think what you want to really zero in on, though, are companies and if they're getting their credit lines expanded in the U.S. and if they're able to keep attracting capital to expand their purchases and their property wells and the like. So certainly, and their well development on property. So that's what I'd be keying on going forward. I'd keep a really close eye on that. And again, like in Canada, we've also had this. The industry has been well aware of investor appetites in terms of being conservative in terms of allocating capital, and we've seen a lot of discipline in the Canadian oil patch. They have been focused a lot more than in the past on free cash flow and trying to generate that, where I'm not so sure that same discipline has taken hold in the United States. So the Canadian oil patch may actually be slightly ahead of the game in terms of discipline and would be in a better position, I think, should we get even a sort of a consolidation period in crude oil. We've already gone through that sort of period of discipline rationalization where that may not be the case as much in the United States. So it'll be interesting going forward. The U.S. has had a pretty good run here in terms of the oil patch versus Canada, but we'll see going forward if that is able to if they're able to maintain the same type of outperformance. But based off of our signals, we think there's a pretty good chance that there's going to be a sea change that the Canadian oil patch, because it's got so much gloom already baked into it, that it's ready for a bit of a period of outperformance here against the United States now, and that's and I raise that because there's been a lot of talk about how the grass is greener on the other side of the border, and I just wouldn't. I would just start drilling down a bit on that narrative and take a skeptical view of that, and realize that in Canada, we a lot of that negativity is already reflected in share prices.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ted Dixon. Ted, if there's a real separatist talk and any feeling that might happen, wouldn't that just chase more investment away from the Alberta and Saskatchewan energy patches?
If it gets serious, where you've got a political movement that is close to gaining power, for sure. We saw that happen in Quebec in the 70s, where a lot of businesses fled for good, but I don't think we're there yet. And this makes great content for the media to talk about, but I think there's going to be some serious negotiations going on between Alberta and Ottawa in the next few months, which is probably a very good thing. Let's just see how those unfold before we take the issue of potential Alberta and Saskatchewan separation into the realm of impacting investment decisions, because I don't think we're quite there yet.
Well, if it comes to equality payments, Alberta, BC, Saskatchewan don't get any. Newfoundland doesn't get any. It seems like if you have any kind of energy resource, you're at the poor end of the stick in Canada. You can see why people might be upset.
Absolutely, and I can understand. I mean, and Jason Kenney makes a very good point, where under the current arrangements, there's almost this incentive for provinces not to develop their natural resources if they don't want it, because they don't want to get their hands dirty. My goodness, and they'll get a check essentially from the federal government. So, I think there's a legitimate grievance there, and that's something that Ottawa is going to have to sort out.
Now, U.S. interest rates continue to fall. Do you think that's going to be maintained? Are they going to stop now, or is the Fed going to trim rates even more?
Well, that's a great question, because there's so many dimensions to it. And what I mean by that is there's the short dimension and the long dimension. There's the short dimension that the Fed has control over. Excuse me. And I think you'll see, what Jay Powell has said is that they will not be raising interest rates again until inflation heads back up. So that's a really, really good development for the commodity space. Because as much as we talk and hear about negative government debt, trillions of dollars of negative debt, at the end of the day, commodities are what we'd call sort of a short-term investment, in that if you're speculating in commodities, you're not planning to, hold a tanker of oil for 20 years. Okay, that's not the plan. If you're going to speculate on oil, you might want to try and play the curve for, the curve. You might want to try and take delivery and sell into the future over a few months, maybe over a year or two, but 10 years, no. Now, what all this negative bonds, government bonds have helped, is helped real estate primarily, and that's the asset class that's probably most at risk here, in that if the Fed continues to sort of focus on short-term rates and keep those lower while the long-term rates start to creep up, you're going to get a switch out of the money is going to flow more into the commodity area and out of the real estate area. So, that's not going to happen overnight, but that is something to keep your eye on, because the Fed basically is telling us to favor the short end of the curve. When Bernanke started QE1, QE2, QE3, basically they were saying, go buy bonds. Mario Draghi, when he did QE in Europe, he basically said, go buy bonds, go front run me, because I'm going to be there holding the bag. You dump all your stuff onto me and I'll take it because I'm the central bank and I can do it. So you just go out and buy 100-year Austrian bonds, whatever you want to do, right? Greek bonds, whatever, and I'll buy them from you. Okay, that's basically what Mario Draghi was saying, and Bernanke was saying QE in the U.S. was Uncle Sam bonds and mortgage-backed securities, okay? So not Greek bonds, but basically the Fed was saying, go buy long-dated instruments, and I'll be there to take them off your hands, and you can make a profit at it, okay? Well, now the Fed is saying, go buy Treasury bills, and I'll buy those from you, and that's a big switch, okay? So everything you may read on the internet that this is just QE without a different name. It's not QE. There's a big difference between what Bernanke did and what Jerome Powell is doing. It's going to favor different assets. And all things being equal, this is going to favor commodities. It's not going to favor real estate. Unfortunately for commodity investors, it's more than just, the Fed buying Treasury bills that's going to impact. You got to look at global growth as well. But on balance, this should help the commodity space, whereas over the past 10 years, the Fed has been no friend to the commodities complex, and you can just see that in commodity prices look back over the past 10 years.
We'll have more with Ted Dixon right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, is industrial output in the U.S. falling?
Well, it's pretty much assumed that the U.S. is in sort of a manufacturing recession right now, and there's a lot of potential drivers behind that. The trade wars, for example, the issues in the auto industry. So there's a lot going on where you could point to that there's a recession in the U.S. in that part of the market. However, I think the consumer and the service area continue to be strong, and that's kind of what's holding things up here. That's what has the bulls in the U.S. Still optimistic that things can keep going, along with the Fed, who's in no hurry to raise interest rates. So the bears, though, will say, of course, that this is going to catch up to the whole economy. It starts in the real economy, the industrial area, and it's only a matter of time before everything gets infected with this downturn. So, we'll have to see how that plays out. There's good arguments on both sides of the equation based on, on what we've written out to our subscribers this week. We would be a little cautious here on the U.S. These all-time highs. I think you've got to look at stocks that are gonna do well under a Fed that's buying Treasury bills, and you've got to be mindful that there are these pressures in the real economy, and that you can't ignore them. So, our base case is that probably the S&P 500 is going to go back and try and test that 2,900 level at some point. And while things kind of work out here, and of course the other wild card, which very few people are talking about yet, is the U.S. election year coming up. There's a lot of uncertainty around that. We'll see if the algos and the index funds, which the Encana CEO is falling in love with, apparently, whether they start to detect some type of risk there, and we start seeing some money move out of the U.S. into more shorter dated instruments to ride out the election uncertainty. Because if you do get Elizabeth Warren or Bernie Sanders as a challenger to Donald Trump, you could be looking at a very different world a year from now if one of those two become president of the United States.
And we all know how fast a year can go. It's been 3 years since Donald Trump was elected. And I remember the countdown to the 2010 Vancouver Olympics, where I was part of the radio TV consortium. It seemed to go so slow, and then the last year, blink, it was right on top of you, and now that was 10 years ago. So whenever somebody says, it's a year away, it's going to happen faster than you think.
That's right. That's exactly correct.
Ted, do you think they're going to be able to resolve the Chinese-U.S. trade war, or is this thing going to drag on? Because as the Chinese do, they have 5, 10, 25, 50-year, 100-year plans.
I think it really depends on how tough the United States are going to hang in there on their demands. And that's a tough one to call. It's election year. But I think there's a consensus that the U.S. wants a deal before the election, and I think they do want a deal before the election. However, if the Chinese and the U.S. are unable to come to a deal, I think Trump would feel quite comfortable running for re-election on that, saying, I tried to make a deal with the Chinese, but we can't get a deal, and you need to re-elect me because I'm the only one who can really force them into a deal. And I walked away because I'm not going to sign a bad deal. So I think there is a risk that there is no deal that gets done. That said, I think both sides would like one. The question is how hard are the Americans going to press their demands, because I think the Chinese are only going to move so far, and they'll take the pain. They've already taken quite a bit of pain already, and my view is that they'll have some lines in the sand that they won't want to cross, and that if the U.S. doesn't kind of take what they're offering, the Chinese will probably wait it out and take a bit more pain here. But I could be wrong. I mean, let's hope that they do get something. But it's not baked in the cake yet. And look, even if they do get a deal, Jim, it's not going to be this. It's not going to solve all the issues. It's not going to solve the issues in the auto industry, where where you've got not only demand issues, but you've got this transition to electric vehicles. So there's a lot of issues out there that even a deal between the U.S. and China are not going to solve. I would keep a closer eye on what's happening in the credit markets. Are credit spreads widening? Is the Fed going to continue to add liquidity to the system? I think those are the underlying trends that are going to drive the market globally over the next year. I just don't see the trade deal being a sustainable headwind or tailwind I don't see it being a sustainable tailwind to the market. If there is no deal, it could certainly be a headwind. But even if they get a deal, look, we saw what happened after NAFTA got resolved here in Canada. The Canadian market went up for a few hours, and then it headed right back down into the Christmas Eve washout. So I would be very very cautious on any major rally, unless we get some kind of amazing trade deal, which would be an out of the box kind of result, would be a great result. But I think the chances of that are probably less than 5%, but we can always hope for the best.
Ted, thank you so much for chatting with us.
Well, thanks for having me back.
If you have any questions for Ted or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.